I've invested 667 million euros in index funds and ETFs as co-founder of a European investment company. Let me show you the most surprising and little known investing lessons that I learned along the way, which could boost your profits and help you avoid expensive mistakes. And lesson 1 is critical for beginning investors. To explain it, let me ask you this. Can you say for sure which team is going to win the next FIFA World Cup? Well, you can probably guess that Botswana, or my country, Latvia, is not going to win. But there is no way to be certain who is going to win. If you put your money on Argentina or Spain or Germany or England, well, chances are you will do well. But there are no guarantees until the games are actually played. And the same principle applies to investing. I've seen so many beginning investors spend months or even years trapped in analysis paralysis, where you are trying to guess which strategy is going to perform best. Should you invest in American stocks or European stocks, large cap or small cap, growth or value stocks? The market is incredibly complex. There is no way to be certain which is the winning strategy. The worst thing you can do is just delay forever and not even get started because you're afraid to make a mistake. So lesson 1 is this: there are many good investment strategies out there. As long as you're diversified, as long as you keep costs low, chances are you're going to do quite well, even if your strategy isn't the absolute number one in terms of profits. The second lesson is something that often gets smart, educated investors into trouble. And to explain it, let me present a paradox. According to World Bank data, the economy of China grew an average of 8% per year in nominal terms over the past 15 years. By contrast, the US economy grew around 5% per year over the same time period. But if you look at the stock market, you see the exact opposite. The Chinese stock market grew 5% per year compared to a much more powerful 14% per year for the American S&P 500. So what explains this contradiction? Well, there are at least 4 reasons that are essential for investors to understand. The first reason is that the stock market doesn't reflect the real economy. If, for example, a lot of the economy is made up of small businesses or farms, and then the stock market is made up of industrial companies or IT companies, clearly they're not going to move in sync. The second reason is that just because some sector of the economy does well, it doesn't mean that the stocks in that economy do well. For example, imagine that a country's IT sector has performed really well. It could be because there's been a bunch of new competitors coming into that sector, pushing out the established companies on the stock exchange. So maybe the established companies whose stocks you could buy, they have performed poorly, and you had a poor return, while the overall industry has become really powerful. The third reason is that, especially in emerging markets, the profits from companies don't always end up in the pockets of shareholders. They have a way of finding their way to government officials or family members or other company insiders. And the fourth reason is that stock prices already reflect expectations of economic growth. So, for example, if everybody expects the Chinese economy to grow really fast, well, stocks are going to be more expensive. So when you jump in, you pay more, and that reduces your expected return. So all of this leads me to lesson number 2, which can help you avoid so many mistakes. The stock market is not the economy. And you don't pick stock investments based on which economy you expect to perform the best. The next lesson is something that even my best investing students sometimes struggle with. They come to me with good ideas. Like, for example, clearly there's going to be a lot of military tension between Russia and Europe. So Europe is going to spend a lot on defense, right? So why not buy up European defense stocks? Or clearly the AI revolution is here to stay. So why not buy a semiconductor ETF or an AI ETF? The idea in and of itself is not bad, but the problem is usually that you are way too late. Unless you are a professional investor who watches the market and the economy all day, every day, and jumps on opportunities as soon as they appear, by the time you have an idea like this, thousands of investors all over the world already had the idea, they put money into the market, they pushed up stock prices in the relevant industry, and the opportunity disappeared. So lesson 3 is this: your best ideas are already priced into the market. Unless you're a professional, your best approach is usually simply to buy some index funds and ETFs and not try to outsmart the market. I've got to confess, the next lesson is something that stresses me out because I often talk to beginning investors who have just put some money into the market and they tell me, Tom, this is my life savings. I'm really worried. What if there is a market crash? And to me, this is such a backwards way of thinking about it. Market crashes are not something you say, what if about. Market crashes are inevitable. They happen on a regular basis. If you're putting your money into stocks, you should fully expect the market to crash sooner or later, and you need to be prepared. Just to give you an idea, the stock market goes down around 1 out of 4 years. And over a typical 10-year period, you are likely to spend 12 whole months sitting with losses of 20 to 30% compared to the market peak. It is perfectly normal to experience significant losses in the market. So lesson 4 is this. Don't be afraid of market crashes. Expect them. They are going to happen, and there's no point fearing something that is inevitable. Instead, you need to be prepared. What that means is that you need a safety cushion, which is sitting aside and not invested. You can use this money to cover any emergency needs when the market drops, so you are not forced to sell. You need to make sure that the risk level in your portfolio is something that you are comfortable with. If you are a fearful person, you should probably not have 100% of your savings in the stock market. And you need to have a plan in place for how you will react when the market falls. Usually, from a long-term investing perspective, the right plan is to keep investing because this will be a chance to buy stocks at a cheaper price. Now, if you are already retired, then this does become a little more critical because you are taking money out from a portfolio at a time when the market is down. So you should also make a plan to potentially reduce your spending when the market falls. The next lesson is simple. Follow the money. When it comes to political scandals, everybody understands that you have to look at who's making money and why. But when it comes to investing, people often forget this. For example, a lot of European investors seem to think that it's a good idea to ask for investment advice at your bank. But this can be quite dangerous if you don't follow the money, if you don't understand how your bank makes money. They make money by selling you expensive investments so that they can charge you high fees and move money from your account to their account. As a result, the investment advice that your bank gives you, well, while it's better than not investing at all, it's usually quite expensive and gets you suboptimal results. You should also apply the same principle when it comes to YouTube influencers. When you see somebody selling a trading course or a crypto scheme, ask, how does this person make money? Why aren't they just making money with their crypto or trading instead of teaching on YouTube? And of course, you should also ask this about me. Why am I creating videos about ETFs or index funds? Why am I offering my training programs? Like the Index Masterclass, which is an amazing program for beginning investors in Europe. If you want to learn how to go from A to Z with ETFs or index funds, you should follow the first link in the description to find out more. But why am I doing this? Well, in my case, for example, I know that ETFs and index funds are not a ticket to get rich quick. You cannot put in a little bit of money and become a millionaire. Everybody who uses ETFs or index funds has a job or business. In my case, it's training investors. So you make some money, you save some money, and then you use ETFs or index funds to multiply that. To explain the next lesson, let me ask you this. Do you want this apple? Well, what if I told you that this is a special exclusive apple which is only available to people with a high IQ, with a lovely personality, and with a bank balance of at least 100,000 euros? How about that? Well, the thing is, when something is exclusive, when something is only available to a limited group of people, psychologically, we are attracted to it. We feel like it's special and we need to have it. But in investing, this often leads to bad results. For example, as you become more wealthy, as you get calls from private bankers and wealth managers, they will tell you about exclusive investments like hedge funds and private equity funds that you can now access. But there's a reason why these investments are exclusive, and it's not because they're super profitable and safe. It's actually because they are considered risky and complex, so regular people should stay away. For example, hedge funds are these investment funds for rich people, and they claim that they can do all kinds of miracles to make your money grow, but they famously underperform simple index funds or ETFs. Private equity has this amazing reputation of being able to beat the stock market with amazing results. But I did a video recently where I explained why, if you really dig into the data, private equity really struggles to get better results than ETFs or index funds, and they have significantly higher risks and a lot less liquidity. So exclusive investments quite often are not nearly as good as they appear. The next lesson is something that really frustrates me here in Europe. We don't have a long tradition of stock investing. People are very concerned about losing their money in the market, and that's understandable. But because of that, many Europeans really love bonds. Okay, so when you buy a bond, it's essentially a loan that you are making to a government or a company. And it seems very safe because unless the government or company goes bankrupt, they have to pay you back. But the problem is, and this is our next lesson, over the long term, bonds are not safe investments. They only appear safe because they are predictable. But when you think about it from a long-term perspective, safety in investing is having enough money to cover your needs. And if you put a lot of money into bonds, chances are you will not have enough money to cover your needs because bonds often don't even cover inflation. If you want your wealth to grow over time, then you want to have a significant part of your wealth into higher volatility assets like stocks or real estate, where you can expect the value to grow even after adjusting for inflation. But this leads to a different kind of mistake, where people hear that stocks are amazing. They've heard that developed world stocks earned an average of 9% per year over the past 50 years, for example. So they rush into buying individual stocks. The challenge is that yes, the overall market does really well long term, but individual stocks are actually incredibly dangerous. When you look at long-term stock data, as many as 40% of all stocks sometimes experience catastrophic losses. In as many as 11% of cases, the stock goes to zero, so you lose everything. This seems really confusing. Like, how is it possible that the market as a whole is very profitable, but the average stock is a loser? Well, this mystery is explained by something called skewness. Returns in the stock market are not evenly distributed. There are a lot of poorly performing stocks, and then there's a handful of really, really well-performing stocks that bring up the average for everybody else. The problem is you can't know which will be the winners ahead of time. So for most people, unless you're a professional investor, it is much smarter to use a diversified investment like an index fund or ETF. That is how you could have earned those 9% per year over the past 50 years. And of course, the future is likely to be different from the past. The same results are not guaranteed, but this is still the smartest approach if you start investing your money today. Now we've got a lesson which, as an investment trainer, I find it difficult to admit, but it's true. The single most important factor for your long-term success is not your investment strategy. You have to understand that investing is what's called a loser's game. To win at investing, you don't have to be brilliant. You don't have to win the game. You just have to avoid losing. You have to avoid big mistakes like picking individual stocks or timing the market or paying high fees. If you do that, chances are you will do great. So in reality, there are many good strategies that will serve you. You simply pick one and go ahead. The single most important factor for your long-term success is your savings rate. So once you've learned investment basics, once you have a good strategy, you've picked out some ETFs or index funds, you have a good brokerage, you know how to handle taxes, you shouldn't be spending a lot more time and effort on investing. It should take maybe a few hours per year, and the rest of your free time should be dedicated to making more money and saving more money. That is what is really going to build wealth for you over time. For the next lesson, what if I told you that two different investors in two different European countries could buy the exact same ETF and get wildly different financial results? Well, what if I told you that two different investors in the same country could buy the same ETF and get very different results? It's counterintuitive, but it's true. Your investment results will be heavily influenced by how tax optimized your portfolio is. For example, in the UK, you can buy an ETF in a taxable account or in an ISA. And if you're using an ISA, which lets your money grow tax-free, you will be much, much better off. In other countries, you have other solutions like the PEA in France or the TBSZ in Hungary. Before you start investing, it is crucially important to understand the lay of the land. What are the tax rules in your country and what kind of investment strategies are optimal for taxes? It can be overwhelming. There are so many questions, there's so much information coming at you, so many people get stuck and they delay for months or years. In this YouTube channel, channel, I try to solve this problem one video at a time. But if you would like a faster solution, a training program which gives you everything that you need organized step by step, then check out the Index Masterclass. It's a training that I've been running for years. It's got thousands of happy members all over Europe, and you can find out more by following the first link in the description.